Level 1. Negative balance. Level 1. The account slips below zero. Maybe it's negative $5. Maybe it's negative $500. The amount feels important to you, but to the system, it barely changes the outcome. The response is automatic. The moment the balance crosses the line, the machinery activates. A fee appears, usually within hours. $30, sometimes $35, sometimes more if multiple transactions land while the account is already underwater. A coffee purchase, a streaming subscription, a gas station payment, all processed separately, all punished separately. The deficit multiplies faster than the money ever did. The logic is strange when you stare at it long enough. The people most likely to trigger overdraft fees are the people least equipped to absorb them. If your account had enough money in it, none of this would happen. But because it doesn't, the system removes even more. Poverty compounds itself in tiny digital increments. You stand at a checkout counter trying to buy groceries. The card declines. You tap again because sometimes the machine is wrong. It declines again. The cashier avoids eye contact. The people behind you pretend not to notice while absolutely noticing. Your brain starts racing through numbers you were not prepared to calculate in public. Did the electric bill already clear? Was the transfer delayed? Did the subscription renew today instead of tomorrow? You are solving a financial puzzle under fluorescent lights while the terminal keeps flashing insufficient funds. That is what financial pressure usually looks like in real life. Not dramatic music, not cinematic collapse, just ordinary embarrassment stretched across ordinary moments. A declined payment, a silent panic, a receipt that never prints. The bank offers overdraft coverage as a convenience. In practice, it means the institution approves the charge anyway, and then bills you for the privilege afterward. The transaction goes through, your tank gets filled, and several hours later a fee quietly lands on the account. The humiliation is avoided in public, but the penalty arrives privately. Some institutions reduce these charges after years of criticism and regulation. Others simply adjusted the wording while keeping the structure intact. Billions of dollars are still collected annually from overdraft-related fees, and a large percentage of that revenue comes from a relatively small group of customers repeatedly trapped in the cycle. The same accounts absorbing the same penalties month after month. At this level, access is extremely limited. Credit is difficult to obtain. Flexibility barely exists. Nobody calls to ask whether your paycheck arrived late or whether an unexpected medical charge pushed the balance negative. The system does not know context. It does not know your rent increased. It does not know the automatic payment came 2 days earlier than expected. It recognizes one thing only: the account balance is below zero. Everything after that is procedural. You are not really being treated like a valued customer here. You are being processed as a risk category, a line in a database, a deficit the institution intends to recover as efficiently as possible. Level 2. Low balance. Level 2 is technically stable, but only technically. The account is positive again. There might be $200 sitting there, maybe $400 on a good week. Occasionally $600 before rent, utilities, insurance, and groceries pull it back down. You are no longer drowning, but you are still very close to the surface. This is where maintenance fees begin to matter. $12 disappears automatically because the minimum balance requirement was not maintained. Maybe the threshold is $1,000, maybe $1,500. Either way, the condition feels absurd, because if you had enough spare cash to leave untouched in the account permanently, you probably would not be worried about monthly service charges in the first place. You are paying a fee to store money you barely have. The savings account exists mostly in theory. The interest earned is microscopic, fractions of a percent annually, numbers so small they barely register. Meanwhile, the institution uses deposited funds to issue loans, credit cards, and financing products at rates dramatically higher than what depositors receive. The gap between what they pay you and what they earn elsewhere is part of the engine that powers banking itself. At this level, your balance is simply too small to inspire competition. You apply for a credit card and receive an offer for a secured card instead. To open it, you provide your own deposit as collateral. In effect, you hand the bank money so they can temporarily lend it back to you, while charging interest if you carry a balance. It sounds backwards when described plainly, yet this is one of the standard entry points into the credit system. The experience is not openly hostile. That is the strange part. It is mostly indifferent. Customer service representatives are polite. The app functions normally. The ATM works. But when a complicated issue appears, you wait on hold listening to recorded messages before eventually speaking with someone, following procedures from a screen. Simple problems get solved. Unusual ones disappear into escalation departments you never actually interact with. There is no personal relationship at this stage, only infrastructure. The institution provides the minimum required services because that is what the account type promises, nothing more. You are not important enough to receive special attention, and not wealthy enough to generate meaningful urgency. You exist inside the system as a small account, with small balances producing small revenue. Most of the interaction is automated, because automation is economically efficient when dealing with large populations of ordinary customers. Level 3 begins quietly. There is no ceremony attached to it. No message arrives announcing your transition. The change happens through patterns. Your paycheck becomes consistent. Direct deposits arrive on schedule every 2 weeks. The account history stops looking chaotic and starts looking predictable. Income enters regularly. Bills leave regularly. The algorithms monitoring risk and profitability notice before you do. Suddenly the offers begin appearing. Real credit cards now, not secured ones. Cards with actual limits attached to them. $2,000, maybe $4,000. The interest rates are still high because your credit history is still developing. But the institution has decided you are now statistically useful. 6 months earlier, the same bank had almost nothing to offer you besides basic checking services. Now advertisements appear inside the app, recommending personal loans, balance transfers, and financing products. Your financial profile crossed an invisible threshold, and the system responded accordingly. You apply for a small loan because your car needs repairs. Approval arrives within a couple of days. The interest rate is not especially good, but the process functions smoothly enough that it feels almost surprising. For the first time, the institution behaves the way people imagine banks behave when they hear financial advice growing up. You need money. You apply responsibly. The bank says yes. The maintenance fees often disappear at this level because consistent direct deposits qualify the account for waivers. That small change feels larger emotionally than it does mathematically. After spending years paying penalties simply to maintain an account, the absence of those penalties feels like progress. And it is progress. You are becoming commercially valuable, not personally important. That distinction matters. The institution wants to keep you because your transactions, loan interest, and growing balances now generate reliable revenue streams. You are no longer merely surviving inside the system. You are participating in it successfully enough to become useful. That usefulness changes how the institution responds to you, not warmly, not generously, but functionally. Level 4 is where consistency begins compounding into leverage. Not overnight wealth, not dramatic success, just years of relatively disciplined decisions, slowly altering the numbers attached to your profile. The savings account grows into 5 figures. Investments begin accumulating alongside it. Credit cards are paid in full most months, making the actual interest rates almost irrelevant because balances rarely remain long enough to accrue serious charges. Your relationship with debt changes here. Borrowing stops being an emergency tool and starts becoming a managed instrument. Credit limits increase automatically without requests. 1 month the available limit is $6,000. Later it becomes 10, then 15. The institution extends larger amounts of credit specifically because your history suggests you probably will not misuse it. That is one of the quieter ironies of finance. The people most trusted with borrowing are often the people least desperate to borrow. Loan terms improve too. Car financing becomes cheaper. Interest rates shrink because the institution now sees lower probability of missed payments. The cost of money itself declines as your financial profile strengthens. That difference matters more than most people initially realize. Lower borrowing costs mean less money disappears into interest. Less money lost to interest means more money remains invested or saved. More capital remaining in your control accelerates future growth. Wealth compounds partly because the system gradually reduces friction for people who already appear financially stable. The change is subtle. It happens through percentages, approvals, waived fees, and favorable terms rather than dramatic events. But over time, those small advantages stack together. You are no longer viewed as merely another retail account. The institution would prefer not to lose you now. If you mention moving your money elsewhere, retention offers may appear. Better rates, temporary incentives, priority assistance. Not because the bank cares emotionally, because your profile became economically attractive enough to protect. Level 5, Preferred Client. Level 5 is where the experience begins feeling noticeably different. Combined assets climb into 6 figures. Savings, retirement accounts, investments, maybe home equity, all together forming a financial footprint larger than what most retail branches encounter daily. Now the support systems change. Phone calls route differently, hold times shrink. The representatives handling your account have more authority. Fees disappear with fewer questions asked. Problems get solved in one conversation instead of 5 transfers. Eventually, a dedicated advisor may appear. Someone assigned specifically to customers at your asset tier. A real name, a direct email address, a person who recognizes your account before opening the file. It resembles a relationship because, commercially speaking, it is one. The institution wants future business from you now, not just present balances. Mortgage products, investment accounts, premium cards, retirement planning services all begin arriving proactively. The bank is no longer reacting to your needs. It is anticipating future opportunities connected to your financial trajectory. Rewards improve too. Cashback percentages increase. Travel benefits appear. Exclusive account types unlock. The products available at this level are objectively better than the ones offered lower down the ladder. That difference is not accidental. Banks compete hardest for customers statistically likely to generate long-term profitable relationships. By this point, your history suggests reliability, stability, and growth potential. The institution begins investing resources into keeping you inside its ecosystem. You are now recognized internally as a customer worth retaining. That recognition changes everything, from service speed to product access. Level 6, High Net Worth. Somewhere between $500,000 and $1 million in investable assets, the banking experience transforms again. At this level, financial management becomes less transactional and more strategic. Wealth advisors enter the picture. Tax planning discussions begin. Estate structures, investment diversification, retirement projections, insurance optimization, all folded into coordinated conversations designed to manage larger financial systems rather than individual accounts. The quality varies dramatically depending on the advisor and institution. Others are essentially polished sales representatives pushing expensive products. Learning the difference becomes financially important because mistakes at this level cost real money. The conversations themselves change tone. Nobody is asking whether you qualify for a basic loan anymore. Instead, discussions revolve around long-term goals, risk allocation, inheritance planning, business interests, and asset protection. The institution attempts to understand your entire financial landscape because controlling more pieces of that landscape increases profitability. The motivation remains commercial. The experience becomes personalized anyway. Operational problems also disappear faster. Fraud alerts, transfer delays, frozen accounts, unusual transaction reviews, all resolved rapidly because your profile justifies expedited attention. Representatives handling these situations possess actual authority rather than scripted responses. That authority changes the experience profoundly. You are no longer treated like a standard consumer account. Internally, you become something closer to a managed financial asset. Procedures adjust accordingly. Response times accelerate. Flexibility expands. The institution inside the building remains technically the same bank lower-income customers use. But the version of the bank interacting with you now functions almost like a separate organization entirely. Above several $1 million in assets, banking enters territory most people never directly see. Products appear that are absent from public websites. Specialized investments, custom lending structures, negotiated rates unavailable to ordinary customers, opportunities requiring accredited investor status or significant relationship history. Mortgage terms improve substantially because borrowers at this level represent extremely low risk paired with high-value ancillary business. Over the lifetime of large loans, the savings generated through these preferential terms can equal tens or even hundreds of thousands of dollars. Teams replace individuals here. Investment specialists coordinate with tax experts. Estate attorneys collaborate with wealth managers. Meetings occur in private offices designed specifically for affluent clients. The atmosphere changes because the stakes change. The important distinction at this level is discretion. Retail banking policies contain flexibility built into them, and that flexibility is exercised far more generously for clients generating substantial revenue. Waiting periods shorten. Internal processes accelerate. Not because laws changed, because profitable relationships justify greater effort. The rules technically remain the same across customer classes, but their practical application becomes increasingly favorable as account value rises. That is one of the least publicly discussed realities inside modern banking systems. Wealth does not merely purchase luxury. It purchases optionality, responsiveness, and institutional flexibility. Level 8. Private banking. At the highest tier, banking stops resembling ordinary consumer finance altogether. Private banking is not simply premium customer service. It is a separate ecosystem operating inside the same institution. Private bankers manage very small client lists, sometimes fewer than 20 relationships. Their role extends beyond transactions into long-term coordination of family wealth, investments, lending, philanthropy, business structures, and legacy planning. They know personal details because understanding those details improves service and deepens institutional retention. The arrangements at this level are heavily customized. Loan terms are negotiated individually. Investment access expands dramatically. Transaction timelines compress because internal departments prioritize these accounts automatically. Rules become more flexible, not illegally, but operationally. Fees disappear without requests. Exceptions receive approval rapidly. Complex transactions move faster because employees across departments understand the value attached to the relationship. Decisions that might take weeks elsewhere happen in days. The system that once felt cold and automated at the bottom becomes deeply human at the top. Not necessarily kinder, but far more attentive. At this level, the relationship itself becomes strategically important inside the institution. Retaining you matters to careers, performance metrics, and departmental revenue goals. Losing your accounts would have visible consequences internally. That creates a completely different form of leverage than anything available lower on the ladder. And that may be the clearest divide running through the entire financial system. The less money you have, the more rigid the system becomes. The more money you have, the more flexible it becomes around you.